This doctor wasn't hiding money overseas. He wasn't creating fake deductions. He simply deposited part of his business income into his personal bank account. Years later, the IRS reconstructed the entire flow of money. What looked like a harmless banking habit became evidence in a serious tax case. And here's the part every business owner needs to understand. The personal bank account wasn't actually the biggest mistake. It was what happened after the money went into that account.
Wait, are you saying depositing business income into a personal account is illegal?
Not necessarily, and that's exactly why this case matters. One deposit doesn't automatically create tax fraud, but when business income moves outside the business records and never makes it onto the tax return, the IRS starts asking a much more serious question. Did every dollar the business earned actually get reported? That question changed everything. Let's open the file. This case didn't begin with one bad deposit. It began when the IRS started asking a different question. Did the business records tell the same story as the tax return? Over the next few minutes, we're going to follow the same trail the IRS followed. We'll look at the bookkeeping, the bank records, the tax return, and finally, the evidence that convinced the tax court. Because once you understand how this audit unfolded, you'll know how to spot the same warning signs inside your own business before the IRS does.
So this isn't just a story about a doctor. It's really about how the IRS investigates a business.
Exactly. And before we're done, I'll also show you 3 year-end steps I would recommend to help reduce the risk of this happening to your business. Let's meet our business owner. We'll call him Dr. Michael Carter. That's not his real name. This story is based on a real U.S. tax court case, but we've changed the names and identifying details for educational purposes. Dr. Carter owned a successful medical practice. Every day, his clinic received payments from insurance companies, credit cards, cash, and patient checks. Like many business owners, he worked long hours. He focused on taking care of his patients, growing the practice, and keeping the business running. Bookkeeping wasn't his priority. And like many owners, he believed something that sounds perfectly reasonable. It's all my money anyway. Some days, the business income went into the business account. Other days, part of those same receipts went into his personal account. He wasn't trying to create 2 different sets of books. He simply believed everything would be sorted out at tax time.
Honestly, I think a lot of business owners would do the same thing. If the money belongs to you, does it really matter which account receives it?
That's the question. And if this case were only about moving money between 2 bank accounts, it probably never reaches the IRS. But that decision created another problem, one that most business owners don't realize until it's far too late. Here's where the real problem begins. The patient paid $8,000, but not all of that money followed the same path. $6,000 went into the business account. That amount was recorded in the bookkeeping. Eventually, it became part of the tax return. But the other $2,000 went into the owner's personal account. If that deposit never makes it into the business records, it becomes much easier to overlook later.
So the problem wasn't really the personal account. It was that part of the business income never appeared in the bookkeeping.
Exactly. Like most tax engagements, the CPA prepares the tax return using the books and records provided by the business. Preparing a tax return is very different from performing an audit that independently verifies every transaction. If business income never reaches the bookkeeping, it may never reach the tax return either. Now, imagine that happening not once, not 10 times, but hundreds of times over several years. A small bookkeeping gap can slowly become a very large tax problem.
So one missing deposit might be an accident, but hundreds tell a very different story.
Exactly. And that's when the IRS stopped looking at individual deposits and started looking at the pattern. This is where the investigation changed. The IRS didn't begin by asking, why did you use a personal bank account? Instead, they ask a much more important question. Did every dollar the business earned actually make it onto the tax return? That's a completely different investigation. To answer that question, the IRS started comparing the evidence. Business bank records, personal bank records, bookkeeping reports, tax returns. One document by itself didn't reveal much, but together, they began telling a different story. Some business payments appeared in the business account, others appeared in personal accounts. Some deposits flowed through the bookkeeping, others didn't. At first, nothing looked unusual. Then, the same thing happened again, and again, and again.
So it wasn't one transaction that caught the IRS's attention, it was the same thing happening over and over again.
Exactly. One unusual deposit might have a perfectly reasonable explanation, but when the same pattern continues for years, the IRS starts asking whether the business records tell the complete story. According to the tax court record, the IRS identified more than 300 occasions where business receipts were deposited into the owner's personal bank accounts. That alone didn't prove fraud, but it gave the IRS a very good reason to keep digging. Let's separate a very common belief from reality. Many business owners think this.
If I own the business and I own the bank account, it doesn't really matter where I deposit the money.
That sounds reasonable, but it's also where many people get into trouble.
Honestly, I used to think the same thing. If the money belongs to me, why would the IRS care which account received it?
Because the account usually isn't the real issue. The bigger question is this. Did your accounting records capture every business transaction accurately? If moving money between accounts causes business income to disappear from the books or prevents your CPA from seeing the complete picture, your risk starts growing. The IRS cares much more about whether your records reflect what actually happened than about which account received the money.
So the personal account was never the real villain. Incomplete records were.
Exactly. The personal account was only one piece of a much larger puzzle. Once enough pieces stopped matching, the IRS reconstructed the entire picture. And that's exactly why the court's decision wasn't based on one deposit. It was based on the story all of the records told together. Here's the turning point. Many people think this case was decided because business income was deposited into a personal account. It wasn't. The court looked at everything together. Not one deposit, not one bank statement, not one tax return. The entire pattern. According to the tax court, the decision wasn't based on one mistake. The court identified multiple indicators, sometimes called badges of fraud. These included repeated understatement of income, inadequate records, business income that never appeared in the books, misleading information provided to the tax preparer, and inconsistent explanations during the audit. Standing alone, one of these facts might not prove fraud, but taken together, they painted a very different picture.
So they weren't judging one transaction, they were judging years of business records and behavior.
Exactly. The IRS rarely reaches a conclusion because of a single receipt. They're asking a much bigger question. Can these records be trusted? Once confidence in the records begins to disappear, every number receives more scrutiny. I want you to pause for a moment. Forget this doctor's practice. Forget this audit. Think about your own business. If the IRS requested every business bank statement, every personal bank statement, every bookkeeping report, and every tax return from the last 3 years, would all of those records tell exactly the same story? Or would they tell different stories? Because that's the question this case eventually became. Now, here's the good news. This case doesn't mean every business owner who mixes accounts will face the same outcome. Every IRS case depends on its own facts and circumstances. But this case does teach us something important. Many problems like this can be identified, and often corrected, long before an IRS audit ever begins, especially before year end. If you came to my office before December 31st, here are the first 3 things I'd review. First, I'd make sure every business payment can be traced from the customer to your accounting records and ultimately to your tax return. Even if money passed through another account, I want to know where it went and whether it was properly recorded. Second, I'd compare your bookkeeping with your bank records. If the books tell one story and the bank statements tell another, we need to understand why before the tax return is prepared. Small differences today can become much bigger questions during an IRS examination. Third, I'd ask you one simple question. Is there any business income, bank account, or financial activity that isn't reflected in these records? Sometimes that one conversation uncovers information your CPA never received, and fixing it before filing is much easier than explaining it during an audit.
So, year-end tax planning isn't only about saving taxes. It's also about making sure your records tell one consistent story.
Exactly. Tax planning is important. Tax savings are important. But none of that works well without complete and reliable records. Good records don't just help prepare an accurate tax return. They also help build credibility long before the IRS ever asks its first question. Before we close today's case, here's the one lesson I hope you'll remember. The IRS doesn't just audit your tax return. They audit the story your records tell. Make sure every record tells the same story.
I think that's what surprised me the most. This case was never really about one bank deposit. It was about everything connected to it.
Exactly. Most IRS cases don't begin with one big mistake. They begin with a series of small decisions that slowly create a much bigger problem. The good news is, those decisions can often be corrected long before an audit begins. That's why understanding real cases matters. Every tax court case starts with a decision that seems small at the time. One deposit, one missing record, one shortcut. Most business owners never expect those decisions to become an IRS case, but sometimes they do. That's exactly why this series exists. Not to scare you, to help you recognize the warning signs before they become expensive mistakes. So if you're a business owner or you're responsible for your company's books, subscribe to Ivy Smart Tax. Every week, we break down real IRS audits, tax court cases, and practical tax strategies into simple, actionable lessons, so you can learn from someone else's case instead of living through your own. Because the best IRS case is the one that never happens. I'll see you in the next case.